So the Nikkei was down 12.4% today. The markets are flashing red, and now you're thinking about selling to wait out the storm and get back in later, right?
Relax, don't do it when you want to go to it. Relax, don't do it.
Well, here's the flaw in that thinking. You didn't know to get out last week, so what makes you think you'd know when to get back in? If you woke up to a sea of bad news in the markets this week, you're not alone. Let's break down what's been causing all the fuss so you have a better handle of what's going on, and then we'll talk about what this all means for you and your investment portfolio and how you can stay in control of your long-term investing by sticking to a disciplined approach to investing that is time-tested, boring in principle, but still hard to stick to because of human emotions, which are totally natural. Hey everyone, my name is Preet, and I'm a consultant to the wealth management industry and a former stockbroker. And this channel is for anyone who wants to learn more about personal finance and investing without all the hype. Okay, so let's start with the 30,000-foot explanation of what's going on. Here's the very simple answer that will put it all into context. All of a sudden, there's a fear of an economic downturn. That's basically it. But going one step further, there is a fear of an economic slowdown off of the back of a fairly long period of time where people have been wondering, shouldn't there be a slowdown coming soon? And to a certain extent, the expectation that the next slowdown is around the corner exacerbates the reaction to when we see data that suggests a slowdown. So while we'll get into some of the data, if you want to understand the very broad strokes, that's basically it. Okay, but let's now look at some of these data points to start connecting the dots. Part 1. What's been happening the last few weeks? Before this week started, we had a lot of tech companies selling off due to reports of slower growth. In the last 3 weeks of July, the so-called Magnificent Seven stocks, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, had lost over $1.5 trillion in market value. Alphabet reported that Q2 earnings slowed, Tesla's profitability dropped due to lower revenues, Netflix warned that Q3 subscriber growth would be slower than 2023. Amazon shares dropped 8.8% on Friday after they said they were expecting weaker revenue growth going forward. And while not a member of the Magnificent Seven, but important nonetheless, Intel dropped 26% after a bad earnings report and news that they'd be cutting about 15,000 jobs and suspending their dividends. So one theme is that a lot of really big companies are slowing down. Part 2 is what happened just last week. The US jobs report released on Friday fell short of expectations. And this came right off of the back of the Fed not cutting rates earlier in the week, which markets are now increasingly seeing as a mistake, and that by delaying the rate cutting cycle, the Fed may have triggered a harder downward spiral for the labor market that could have been avoided had they made the cut. In fact, early on Monday morning, some people were suggesting that an emergency intermeeting rate cut would be necessary, which means that they thought the Fed should cut rates before the next regularly scheduled interest rate decision day. However, as the day went on, those calls diminished, possibly because having an emergency rate cut would be seen as an emergency, which would stoke fear and likely make things worse. Part 3. Enter Japan. The Wall Street Journal is reporting that the weakening economic data for the US, coupled with Japan's strengthening yen, triggered a sell-off of the Nikkei, which was significant. The Japanese stock market index dropped 12.4%, which was the worst single-day drop since October 20th, 1987, the day after Black Monday on markets in North America. The sharpness of the drop is attributed primarily to an unwinding of yen carry trades all at once. Okay, here's a very short primer on yen carry trades. Because interest rates in Japan are super low, investors can borrow yen at very low interest rates, convert the yen to US dollars to buy US assets that are higher yielding than the interest they are paying to borrow the money. And so they profit on this spread in interest rates. Now, that is a very simplistic description. Let me know in the comments if you'd want to see a detailed video explaining carry trades that's a bit more, nuanced than that. However, one of the things you kind of need to keep a carry trade on is that you have to have some sense of stability in the two currencies and interest rate environments, because the overall size of carry trades tends to be big to eke out meaningful profits for institutional investors. But with the US entering a rate cutting cycle and Japan recently increasing rates, there's been a recent surge in the yen compared to the US dollar and a narrowing of the interest rate differential. Add to that, when you buy higher yielding assets and they lose value, that's bad. Your lender could make a margin call, for example, and you might have to cover that by selling assets that are already down. Put all of this together and the trade isn't working right now from multiple different angles, and there's a rush to unwind these types of trades. So what might have happened was a selling of assets that were already going down, and that then turned into a race to the bottom.
There are three ways to make a living in this business. Be first, be smarter, or cheat.
Now, it is possible that this degree of panic selling is contained to Asian markets. As of 2:04 p.m. Eastern Time, the S&P 500 is down less than 3%. Okay, so what does all this mean for our investments? Peter Lynch, famous for running the Fidelity Magellan Fund and certainly one of the most recognizable names in the world of investing, wrote the following in one of his best-selling books on investing. Far more money has been lost by investors trying to anticipate corrections than has been lost in all the corrections combined. In the book where he wrote this, Learn to Earn, which was originally published in 1995, he gave the example of someone who invested a lump sum of $2,000 every year into the S&P 500 from 1970 to 1994. If they had the worst timing in the world and put that annual contribution into the market at the worst time of the year, the day that the market peaked for that year, their annual return would have been 8.5%. On the other hand, if they had perfect market timing and were able to invest on the day the market hit its absolute low for the year, their annual return was 10.1%. He sums it up by saying the difference between great timing and lousy timing was 1.6 percentage points, and that investors will do just fine with lousy timing as long as they stay invested. Now, this is based on having a long time horizon and taking a disciplined approach to investing in markets. If you are speculating and trading in and out of the markets with a short time horizon, that's more akin to gambling than investing. But because many people are investing for the long term, I hope that the following chart encourages you to stay invested. This is from First Trust, and we see the S&P 500 from 1942 to June 28th, 2024. And as we look over these 82 years of returns, we see that bull markets tend to be much longer and bear markets tend to be much shorter but vicious. The average bull market lasted 4.3 years with an average cumulative gain of 149.2%. The average bear market lasted 11.1 months with an average cumulative loss of 31.7%. But some of these bear markets were only a few months long, and even an average loss of 31.7% hurts a lot emotionally, especially when you convert it into a dollar amount. If you had just reached $100,000 in your portfolio, that's a fantastic milestone. You feel great. But then if you saw it cut to $68,000 within a few months, that is a horrible feeling the first time you experience it. Also the second and third time, every time you experience it, that sucks. It's quite easy to get shaken out of your convictions during bear markets, and if you sold out of markets because the anxiety grips you, getting back in is even more of a mind job. You might miss out on a lot of gains. Now, the second thing I'll point out about this chart is that this would represent a under-diversified, highly risky portfolio. This is the equivalent of a 100% equity portfolio that only invests in large cap US stocks. A proper portfolio would be globally diversified, have an overall asset allocation more reflective of your risk profile, with some bonds in there. And the ups and downs would both be expected to be more muted than this chart shows. And it's often said that the best portfolio is the one that you can stick to. So while you might give up the potential of higher returns with a higher risk portfolio, you might actually capture a higher return if you seek out slightly lower potential returns with lower risk in your portfolio, because you're more likely to stick to that portfolio. And if that makes it more likely that you'll stay invested, that's a pretty good solution. Now, if you're still thinking that you're special and that you can time the markets consistently, you might want to check out this video that I made a few years ago, which has some links to some market timing simulators that you can try out to show you just how hard it is. Now, the only thing you might want to do if you don't have a portfolio that rebalances itself is to see if your actual asset allocation has drifted far enough away from your target asset allocation to rebalance. In the end, I hope that this video has addressed some questions you might have had about what's going on. A lot of headlines were pretty anxiety-inducing because mainstream media and social media are all about getting attention at the end of the day. When all these headlines are getting front-page real estate, it does have a tendency to make you think and worry about your portfolio, and that's totally normal. It's a perfectly human response. One of the keys to counteracting those feelings is to have a plan. If you work with an advisor and you're feeling nervous, you are totally within your right to reach out and ask them to go over your investment policy statement, sometimes called an IPS, as well as your financial plan if you have one. If you are a DIY investor, you can consider writing down your own investment policy statement, which reminds me, I promised a subscriber that I would make a video on investment policy statement, so I will do that soon. Personally, I have not touched my portfolio, haven't even looked at it. And that's a major reason that I like passive index-based investing that follows a prescribed set of rules based on academic evidence. I do not care to spend a lot of time managing a portfolio when I know that this approach that is low cost and low maintenance will reliably outperform most investors with almost zero effort and allows me not to have to worry about all the scary headlines because it's all part of the plan. Some might say that that just means I'm a cheap, lazy bastard. And that is accurate. If you like this video, please do hit that like button and don't forget to subscribe to my channel for more videos to help you make sense of the world of money around us, and I will see you in the next video.
Relax.